Cameron, great to see you. Let's try and figure out where we are. Are we late cycle?
Well, I think we have to start by defining what late cycle is. To us, late cycle means that you're seeing decelerating growth at the same time that liquidity is tightening. And that certainly could start to be the setup as we go into 2022. And then we have to look at what the market is telling us about where we are in the cycle. And quite interestingly, we have seen late cycle types of sectors start to outperform over the last 3 weeks. So you think of really defensive things like staples, utilities, healthcare, REITs, all showing more signs of life than they have really since the days of the March 2020 meltdown. So then what we look for is signs that cyclicals are starting to underperform. And a great thing to watch here is the relative performance of discretionary versus staples. So discretionary being risk on, very cyclical, versus staples, which is risk off and defensive. And we've actually seen the most negative volatility in that ratio since March of 2020. So we're starting to see signs that the market is moving late cycle or starting to want to get more defensive and take a little risk off the table. So the way that we would like to play this is to really focus on quality. As we move later in the economic cycle, quality becomes increasingly important. So we want strong free cash flows, strong balance sheets, good ability to return capital to shareholders, because that kind of becomes the ballast in the storm when economic volatility starts to pick up.
So, Cameron, good to see you, by the way. We also truly appreciate your Ninja Turtles to the side there. So we appreciate you bringing that
Turtle power
to us. We dig it. So it's interesting that you bring up that kind of rotation, because Guy and I have been talking about this for a while, that do we actually take any of the price action recently seriously? And I want to point us to an RBC investor survey that they actually released today. And in it, what stood out to me is that the consensus actually is confusion. Lori Calvasino was saying that we see evidence of division on a number of the issues that equity investors are grappling with, suggesting to us that the mood of the market is perplexed and conflicted rather than bullish or bearish. What's your assessment of that?
I think that is actually a very fair assessment, and likely how the rest of 2022 plays out is this sideways chop. So we aren't seeing signs that we've seen really big breakouts in utilities or staples relative to the market. So we're clearly not in new relative uptrends, which would tell us to be a lot more defensive and seek shelter. However, this is the most we've seen of a rotation into these more defensive assets that we've seen really since March of 2020. I think the other really important question to ask is, has tech become kind of the stealth defensive trade? So tech is usually considered a cyclical and a risk on trade. But if you look under the surface, tech actually has a lower beta than utilities, and it has more earnings counter cyclicality than utilities. Tech grew earnings by 7% in 2020 compared to utilities, which saw earnings decline 20% in 2020. So how much are we already seeing this shift to trying to find stability, find security in more defensive areas, which might actually under the surface include those technology names?
Cameron, do I seek out dividends?
Yes, definitely. Because when returns move lower through the cycle, as we get to the later parts of the cycle, we do expect equity returns to be much lower in 2022, which means that the dividend component becomes a larger part of your total return. Also, investors will look to see that kind of income side of things when there's more uncertainty about the price return. So we think that companies that have really good ability to not just pay dividends, but grow those dividends are names that will perform well into 2022.
Cameron, what is your assessment of volatility? It's been confusing to look at the correlations recently, and market action has been pretty whippy. And I'm wondering, how do you either protect yourself against that, like cash, treasury kind of thing, or how do you play it?
So volatility is something that we think that makes cash more attractive, because it provides you optionality when you have cash. Yes, you have the opportunity cost of not being able to be invested. And of course, if you were in a lot of cash starting this year, it certainly hurt with the market up almost 25 or over 25%. But having a little bit of cash in a world where we do expect volatility to pick up does make a lot of sense. There's one good reason why we could see volatility increase as we go into 2022, and that's because leverage within the market is actually quite high. If we look at trader leverage, whether it's margin loans or the number of call options that have been written on a bullish side of things for the market, they've increased substantially. And when those unwind, it can cause a negative catalyst to have a much larger reaction in the market, meaning that negative volatility moves happen kind of in a blink of an eye. So having a little bit of cash or more cash than you might normally have does make sense so that you can step in and take advantage of that volatility, which could move a lot faster than even what we've seen in the past few years.
This was the story, really, of 2021. And I'm wondering if we're going to clear the issue in 2022 or what the lingering problems are going to be.
I think you should get ready for the sequel on supply chains, that it is still going to be a top story in 2022. We are making some progress around the edges. Rail pickups at the ports in particular have gotten much better. And, we're doing a little bit better job of clearing out those empty containers, but there's still a lot to be done. I was talking with Flexport the other week, and they have a tracker that looks at how long it takes goods from the point they leave a factory in Asia to the point where they're picked up at a port and taken to a warehouse. That used to be about 45 days. It's now more than 100. And so I think we're making progress, but the important thing to know is that progress doesn't mean the problem is fixed. What's really driving this is that the US consumer just keeps ordering so much physical stuff. We've seen spending come back for airlines, for entertainment, for restaurants, taking a slight dip now because of Omicron, but they're still buying lots of furniture, home improvement supplies, and that's what's really clogging up a lot of these ports.
Brooke, post-Christmas, what are the chances, and I think we probably need to be specific here about what we're talking about, is there a chance that certain sectors are going to go from famine to feast? All the stuff that's on the boats right now is going to come off the boats, it's going to go into warehouses, and nobody's going to want it.
I think there is a risk of that on the retail side. And you're right that it's important to sort of draw a distinction there. The big retailers like Walmart and Target really pushed to build up a ton of inventory heading into the holiday season. And we've seen some weak numbers in terms of Black Friday spending, Cyber Monday. Now, it's anyone's guess, was that a result of people just shopping earlier because they were concerned about the supply chain, or are people feeling the pinch of inflation and some other economic concerns that they're just not spending as much? But especially for the smaller retailers, if your goods are still on a boat outside of the port of LA, you're not getting them in time for Christmas. And you're probably going to be looking at, selling them at a big discount just to try to sell that inventory. Now, on the industrial side, what companies are saying is that they are selling literally everything that they can push out the door. And that, inventories may be a little bit high at the distributor level, but that just reflects the very strong demand that they're seeing. Now, we'll see if that thesis plays out, but I do think on the industrial side, there's some structural reasons why demand may stay very healthy throughout 2022 and potentially for a few years down the road.
Let's have the anecdotal story, guys. I ordered a pair of sheets April 25th, and they just got to my house yesterday.
A pair of sheets?
A pair of sheets. Well, like sheets, just sheets. I was like, I don't.
You bought sheets?
It's just straight up cotton sheets, and somehow it took like a million months. I don't know what that was about.
But I think it's super interesting because, you can go to a Walmart or a Target and you can get a lot of stuff these days. It's just that they're sort of changing the way that they stock goods. So they've prioritized best sellers. And so your sheets probably weren't a hot item. And so, they didn't prioritize getting that on the boat and getting that to you. But you have this sort of weird dynamic of full warehouses, but also shortages of Alix's sheets.
I have to wonder, though, where I ordered them from and go back on that front. Cameron, I want to get your take on this. What is priced in, say, just take the industrial sector and then we can take the retail sector, what's priced into this and how can you make money off of it?
So we think that if you look at the industrial sector and kind of look at the relative performance, it might look on the surface that the sentiment around industrials is quite core. But a lot of that is really just in the aerospace and defense side of things, which is a very large weight in the sector. So if you look at all the manufacturing companies, whether they're multis, machinery, services, and the transports, you actually see a lot of these stocks trading near peak multiples, even though the PMI is also at or near a cycle peak, which has never been necessarily a great setup for forward returns. So really to see a better improvement in the industrial sector would have to come from A&D doing better next year. But we are concerned that some of these manufacturers, which have been benefiting from extremely strong pricing power, ability to pass all those costs on through to those customers, if growth does start to slow with the PMIs, does that pricing power start to fade? And then we start to have a little bit more margin trouble.
Okay, well, that'll be certainly something to watch out for. Margins are going to be, I think, one of the big themes going into, during next year. Cameron, though, just taking a step back, what I've heard so far, though, is that while Alix may be able to get a pair of sheets more cheaply somewhere in the new year, i.e. we're going to see some maybe retail discounting, nevertheless, the inflationary narrative is going to stay with us. Brooke was talking about this lasting for years, potentially. What does that tell us about the trajectory we're on in terms of Fed policy, in terms of the need for authorities around the world to tamp this down?
So it certainly argues that inflation will stay elevated at least into the second quarter of 2022, where that's when we start seeing the tough comps start to kick in. Really, that's when May of 2021, we saw really high inflation starting coming through. So that should be when the overall headline number should moderate. But where it moderates to is the big question. So right now, there's an expectation that it probably doesn't go back to those pre-pandemic levels because of all of these sticky issues that we've been talking about, whether it's supply chain issues or housing or wages for that matter, all keeping inflation higher than the 2% targets that a lot of the central banks have. But there's something interesting here, which is that if you look at the market-based inflation expectations, they actually show that the market is pricing in long-term inflation a lot closer to that 2% number. The five-year forward is only at 2.13%. That's below where it was in 2018, and actually below where it was in May of this year when we just started seeing some of these higher inflation prints. So the market clearly believes that inflation, those things driving higher inflation today, even though they're sticky, they're not going to stick around in the long term, or that the Fed will be able to step in and really quell that inflation over the long term. And that explains why we can see these 40-year high readings in inflation and yet be near 40-year lows in long bond yields, because the long-term interest rate and long-term inflation expectations are still that inflation will moderate back to that 2% level or close to it, which really does remain to be seen, of course, because of these sticky factors.